I think that innovation is leading the way, as it usually does as we're exiting a bear market. And we don't know if we're through with this bear market or not. We could be in a trading range, who knows? But I'm very gratified to see the leadership has shifted back towards growth, and especially towards innovation. We are always the new leadership, almost by definition. We're focused on the future. What is the world going to look like, instead of on the past, which is what most passive strategies and even benchmark sensitive strategies do.
Hello and welcome to Wealthy Value. In today's video, Ark Invest CEOs and CIO Cathie Wood updates about the market signals in August 2022, her outlook for Bitcoin in the coming few months, and whether or not we are in a recession. Cathie Wood also speaks on innovation, heightened volatility, and economic indicators, along with her analysis on Bitcoin's price performance in last few weeks. Make sure to stick around till the end of this video, where Cathie Wood explains the impact of institutional demand on Bitcoin's price. By the way, are you losing money because of a crypto market downturn? With Margex trading platform, you can open long and short positions so that you can profit even during falling markets. Margex has been nominated by finance magnates as the most user-friendly trading platform. Cross-margin is available on all assets, and you can trade with up to 100x leverage. Keep in mind that leverage trading involves risks. That's why if you don't feel confident enough, you can trade with small amounts. The minimum deposit is only $10 and minimum trade size is $1. You will never find any hidden commissions on Margex, and all deal indicators are on screen and available in real time. It's possible to use 10 cryptocurrencies as a deposit option. For a limited time, you can get a 15% bonus on your deposit. First, sign up through the link in the description. Make a deposit of $300 or more, enter your promo code on the wallet page, and get a bonus of 15% on your deposit amount up to $10,000. And now, back to our video.
The two best performing sectors, consumer discretionary up 15%, technology up about 13.5%. Many of the stocks that cause that are associated with true innovation, disruptive innovation. On the lower end of the return scale, you had comm services up 1%. So that's Facebook and a lot of the social media platforms, which are being pummeled by cuts in advertising. And that's another confirmation that we're in a recession. Advertising is highly discretionary, and companies can pull the plug on it quickly, and they have. Communication services, and then healthcare is the other one that had only a 1.5%. I think the fears associated with the fiscal plan that just passed were part of the reason for that. In the fixed income markets, of course, the Fed increased, and everyone anticipated that the Fed would increase interest rates by 75 basis points on July 27th. That happened. But interestingly, the long-term interest rates did not cooperate, or have not been cooperating with this idea that they should be going up in lockstep with what the Fed is doing. Instead, what we're seeing is long-term interest rates peaked on June 14th at 3.5%. So this is the 10-year Treasury bond yield. June 14th at 3.5%, and even after a bit of a backup today in response to the employment report, the interest rates are down almost 70 basis points to 2.83%. Meanwhile, short-term interest rates, 2-year Treasury yields, they have moved up in lockstep. They're at 3.24. So now we have an inverted yield curve to the tune of 41 basis points. It's just getting more and more inverted. And that's basically the fixed income markets telling the Fed, something's going to give here. It's going to be the economy, which is caving in many ways, or inflation, or both. On to crypto, and we do believe this is a new asset class, so I'd like to feature it. I'd like to highlight our we call it the Bitcoin Monthly Report. I think we're going to evolve it to the Crypto Monthly, but for right now, we're calling it the Bitcoin Monthly. We also have some information in there about Ether. But in that report, you'll find one of the very positive signs that we've surfaced is that the 200-week moving average of Bitcoin. Remember, Bitcoin peaked close to 70,000 last November, and it got down to somewhere in the $17,000 range very recently. And that broke the 200-week moving average. So that was a very negative sign. So the technicians out there were saying, well, if it cannot reclaim and get back up there pretty quickly, then we're probably going to 10 to 13,000. So it has reclaimed the 200-week moving average, which is a little bit above, I think, 21 or 22,000. So that's reassuring. We've seen some stabilization there. And the decline this time around, believe it or not, it was pretty intense, but was not as steep as it has been in the past. Normally it's more than 80% decline. So this was close, but we didn't quite get there. And then the other reassuring piece of news recently that came out was an agreement yesterday announced between BlackRock and Coinbase to partner so that BlackRock could, through its Aladdin Technology Solutions ecosystem, on which $40 trillion worth of assets sit, they wanted a seamless on-ramp into crypto that Coinbase is going to provide. So this is another legitimization of Bitcoin and crypto generally as a new asset class. Some of this may have been caused by demand pull, institutions saying, hey, we want to get involved, and they're trying, but the plumbing was just too difficult. So that's good. We did a study on institutions moving into crypto. You can see it in our Big Ideas 2022. You can see the picture. And if we're right, that 40 trillion just from BlackRock's platform hosting other institutions, that would translate, if you just took our study, which basically said if you want to access crypto, but you want to minimize, you're more focused on minimizing volatility than increasing your Sharpe ratio, then you would put 2.5% into crypto. That the surprises are going to be quite significant on the downside when it comes to inflation. On the high yield spreads and credit default swaps, both of those have been settling down as well. So those were moving up fairly rapidly, as I had featured in prior months, but they're settling down. The credit default swap average peaked on June 30th at 104 and is now down to 81. Let's see, the high yield spreads, and what that means is the spread over treasury yields that these high yield bonds are. So they were 6% higher than the 10-year treasury yield on July 5th, and now they're 4.9%. So that's saying with the rally in July, and the rally happened, I believe, because there are more people believing we're in a recession and that inflation will come down. So that rally has taken some of the worry out of these other markets. Now, in terms of commodities, the commodity market, lots of evidence there. Just take copper. Now that's a metric that's really a gauge of how strong the economy is. And so that was fluctuating in the $4 to $5 per pound range for about a year. The copper price peaked finally at roughly $5 in March, and they're now down to $3.54. So that's down 25%. And if you're looking at month to month and year over year, they're both down about 25%. That is going to get into the inflation indicators. Other metrics, I've mentioned gold before, I'll just keep mentioning it. It was in a 2-year trading range. It peaked in August of 2020. Most people don't know that. This is a very good inflation indicator. And it's peaked at roughly 2,100. It's down to 1,790, towards the lower end of that 2-year trading range. So copper broke hard below the trading range. Gold has not done that yet, but it is at the lower end of the trading range. Lumber has dropped to, and I won't give you the exact metrics here, but from $1,711 to $474. So a huge decline there, confirming what's going on in housing and other indicators. We did get the construction report this last week, and it was down 1.1% in June. That's a very rapid decline for that sector. Now, what that misses, however, is what we call illiquid supply. There are hodlers out there, holders for dear life, or I've forgotten what that's all about. Hold on for dear life. And so the illiquid supply, according to our estimates, is about 14 million out of the roughly, I think we're into near 19 million, 18 to 19 million Bitcoin outstanding. So illiquid, 14 million. And by our calculations, only 3 million. If we were to see a $1 trillion increase in demand, then it would probably drive the price up much higher than the doubling that I just mentioned.
So, do you think institutional demand will dictate Bitcoin's price action? Tell us in the comments. Also, don't forget to like and subscribe. See you soon with the next video. Thank you so much for watching.